future. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trade. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither Darwin Investing Network nor its affiliates nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website to read characteristics and risks of standardized options. Darwin Investing Network provides educational and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose, and make all trades in the Darwin Investing Network program in paper trading accounts. Past performance does not equate with future results, and results discussed in this webinar are not typical and are only valid on that specific date or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in media identified above. All right, everyone. Good afternoon. Like I said before, this is Michael McDougall. We've got 106 of you in the room right now and climbing rapidly as we just sent out our reminder emails. It's my pleasure to have with us Phil Davis from Phil Stock World, and you might recognize me from Wealth Creation Investing. I am CEO at Wealth Creation Investing. I'm just going to give a quick explanation. Darwin Investing Network, we're going to be hearing more from going into 2014 with its official launch. And if you think of there being a network of great channels, just like on TV, Wealth Creation Investing is actually one of our channels. Phil Davis is actually one of our channels as well. So now you're going to have the opportunity to hear from more specialists in the field. Phil Davis has a unique story, and he has a very clear and concise skill set, which he's going to be able to share with you today. So with that, it's my pleasure to introduce Phil Davis, but first let me say and answer the question, who is Phil Davis? He's been investing and trading since the age of 7. It's a funny little story associated with that. He might get into that in a little bit. He's an entrepreneur that built a business from scratch and flipped it for millions, making himself and his fellow investors 10 times return on their capital. He's a consultant in mergers and acquisitions on a private basis. He's a #1 author for Seeking Alpha and Market Outlook. All right, and there's some error on the slide there. He's CEO and owner of Phil Stock World for over 7 years. There's over 125,000 visitors monthly to his website, over 4,500 unique visitors daily, hundreds of content contributors, and in short, he knows what he's talking about. So here's what you're going to discover on today's webinar. Phil's top 5 macro trade ideas for 2014 and how to set them up for maximum profit potential. By his way of trading and investing sets you up for long-term wealth potential and presents clear opportunities for short-term cash flow potential, and why you need to approach your stock selection as if you were preparing to buy the company and the exact process you need to follow to achieve desired effect of profit, and how to turn his top picks of 2014 into dividend payers. And, you know, for those of you who are listening, before we actually got started here, Phil was actually referring to his service that he runs with us in partnership with Darwin Investing Network called the Fundamental Profit Room. We're going to be talking about that later on in the webinar for those of you who want to continue on and follow along with Phil and us through Darwin Investing Network. All right, folks, so with that, it's my pleasure to introduce Phil Davis. Phil, I'm going to pass the ball to you, sir, and then you got to press a couple buttons so you can show your screen. And I'm going to mute myself out right now, and I'll be back on in about now.
All right. Hopefully everybody can hear me. And welcome back, everybody. And as Mike said, we did have a little chat beforehand. I figured people are going to show up early. We should be able to give them something to talk about. I'm now going to hopefully figure out how to share my screen. Hang on a second. There it is. I'm going to put you on my screen now. So for those of you joining a little bit after the fact, just so you know, we talked about fantastic things before you showed up, so don't be late next time. We feel like 140 people now. We had 60 earlier. We just had a little chat. All right. Thing number one, I mean, since we're all traders, I think the most important thing is to say, what the hell's going on in the market right now? And what we have right now is we're having a little bit of a pullback. This is nothing we didn't expect. And, of course, don't forget we have the Fed coming up at 2 o'clock with their rate decision. But things have been pumped up ahead of the Fed. Now they're settling back down. People are saying maybe things aren't so fantastic as we thought. Take a look at the dollar. It's 80.20. If the Fed does not taper, the dollar will stay weak. Probably this week, maybe a little bit weaker. If the Fed does taper or talks about tapering in a serious manner, the dollar will go up. That will have an immediate impact on stocks, which are priced in dollars. So you'll need less dollars to buy the stock, and the price of the stock will go down. That's how this stuff works. Same's true of commodities. We're already short on oil. We're short in the in our short-term portfolio. We have SCO. We have an aggressively short play there below the 97.50 line. And in our futures, we've been trading below the 98 line and below the 97.50 line. And that is not what we're here to talk about today, though. Today we're here to talk about macro investing. Although I should, hang on, let me see if I can find chat. There, now I can see your chat window. I don't probably have a lot of time for answering questions today, though, so we're just going to kind of breeze through this stuff. It's not the normal introductory thing. We're doing some simple option strategies. We train on these option strategies all the time. If you do these things weekly, you'll be able to ask questions and find out exactly how to make these trades. We're going to do some basics, and also very important for these stock traders, though, if we like a stock and we're picking the option and we're taking an aggressively leveraged position against it, that means we like the stock too. You can just buy the stock. And we'll talk about that also. That's one thing Mike wants to discuss is the how to turn the stock into a dividend payer. I'll show you that, the basic strategy for options. But as far as the picks we make, that's the point of what we did today, is all these things that we picked, we like the stocks, and we like them for the next year. So keep that in mind, and you're going to have a fantastic list when you're done with this thing. Why can't I hear anything at all? Holy cow, that's not good.
Folks, we went ahead and posted, if you're having problems, well, I guess if you're having problems hearing, you won't hear this. So that's actually kind of funny. Well, there are instructions for feature notice on the right side of the screen in the chat box if you're having audio issues.
Okay, Mike, am I hearable?
Yeah, I hear you loud and clear, Phil.
Okay.
Yeah, you're good to go. You know, we have audio issues.
I got distracted by everybody saying that they. I did the ad blocks. We were having problems with ads popping up. All right, people can hear me, so I guess I'm sorry about. Okay, I'm sorry about the people who can't hear me. Maybe you want to just type something to them and have someone help them. All right. Anyway, sorry, folks. All right, back on track. In the fundamental profit room, when you go to Darwin Investing Network, you will see the macro market overview, and I'm clicking on that. And these are the daily articles that you'll get every morning, and you'll get an idea of what we're trading, what's going on. And we wrote 2 today. I'm going to show you on Phil Stockworld before we can navigate it. We started this yesterday. So there's a lot of picks. This is 2 days worth of picks that we're showing you now. And back in pre-Thanksgiving, we had 5 trades that made 500% in the up market. And now don't forget, we are cash. We took this money and we ran because we are expecting a market turn down. That's our call. In fact, the best call I can make for you right now is cash, take a break, enjoy your Christmas, enjoy New Year's, come back, and we'll make plenty of money in January. And I know that's not what your typical investment guy says. They like you to play the market. They want you to constantly come back and this and that. But I'm telling you that cash is a very valid investing strategy. You don't need to play the market all the time. All right? And yesterday we talked about that in terms of baseball. Like if you played baseball, could you imagine if you swung at every pitch, no matter what the pitch looked like, you just swung because you felt obligated to swing? You'd be terrible. You would have an awful average. All right? The reason good stock traders, they learn not to swing. They learn not to play the market. They learn when it's not a good time to do it. Even if you have a great strategy, there are times when your strategy isn't going to work out, all right? Like we have fabulous strategies for trading oil, but sometimes we go 2 weeks without trading it, all right? Why? Because it's just not the right conditions. It's not lining up properly. Right now, I'm telling you that it's not lining up properly. The market could go higher because the Fed does this and that, or the market can collapse. Why play if you're not sure what's going to happen, especially when we have a ton of strategies that we can make money either way? So like I said, from Thanksgiving, which is only a month ago, we had this trade, this QQQ went up 112%. We had this DDN trade went up 15%. This DBA trade was up 611%. This is against cash. The Apple trade made 190%, and the T trade lost 170%. So what do? Yesterday, we played the T trade because that's the best one. It's the one that lost money. We took this money, cash, and now we put the money into this trade because it lost money. Doesn't that make sense? We played the loser of the group. We took the money and our profits off the table on the winners, and now we put our money, because we still love AT&T, just because we got cheaper doesn't mean we don't like it. And because we're so highly leveraged, you can go down 170%. But what's 170%? It's $1. We started out net 60, and now we're down net negative 42. It's a $1 loss. It's not life and death. If you can get 1,000 shares, 2,000 shares, you're talking about $2,000. And this play can make $5 per share. So you're talking about going down 20% of what you could gain. That's what this really is. But on cash, since the cash was such a low amount that you needed, we're down 170%. But that's frankly, like I said, a chance to double down more than anything else. So we pressed that bet yesterday, and again, go back to yesterday's webinar, you'll see that trade. Here's the list of the stocks that we liked. Our top candidates. Now, this is based on a week of discussion that we have with our members, and our members are some really top-notch traders. We have guys who run hedge funds in our membership. Okay, we have fund managers, we have financial consultants, we have CEOs of major companies. So the kind of guys who are making these picks are not, the rough and ready crowd that you usually have on a website. So our top candidates were these. I'm not going to read them all out because we can discuss them anyway. But this right here is a simple list of our top candidates that we have on our site. We discussed Goldman Sachs' 10 macro themes for 2014. And I mentioned here that the reason we pay attention to Goldman Sachs isn't because we think Goldman Sachs knows anything. They're no smarter than us. I mean, I know these guys. I drink with them. Okay, they're really no brighter than you and me. But they do have more people listening to them than we do. And therefore, when they say something, you have to pay some attention to it because it's what other people are going to do. So Goldman Sachs is anti-commodity. I disagree with them. I think that the dollar is going to be weaker next year. Even if they taper, I think that it's a little bit late to fix the dollar. And we're going to have a drop in the dollar value. We're going to have a rise in commodities. And by the way, if they taper, and if they're right about tapering, the global economy picks up, we're still going to have a rise in commodities because demand will come back as jobs. Why would the Fed start tapering? Because they see lower unemployment. If there's lower unemployment, more people are working. If more people are working, they buy more stuff. If they buy more stuff, commodity prices go up. These are not really complicated macros, but that's the general theme on commodities. We like gold plays. We have 2 of them here out of about 4 that we prefer. Now in each section, we have 4 sections with a few picks each. We're going to try to pick 1 in each one that's our favorite. So you'll be able to go back here and take a look at all these things up. And what we liked the most are ABX, which is Barrick Gold. They're the biggest gold producer in the world. We like IAG, who's a much smaller gold producer, but they give us a tremendous discount. So we take these things into account when we make our plays. So we kind of like IAG just because it comes in at 44% below the price. And so you can make a huge return on the money you put in from doing that. On ABX, we're getting 29% discount, but we're also getting the best gold producer in the world. So it's a 50-50 sort of thing, and you have to weigh it out. Maybe, and as I suggested down here, allocating a little of each to each play might be the way to go. But I'd say if I had to lean one way or the other, I'd probably go with ABX just because I really would want to own them at 1208. I mean, I'd be so happy to own them at 1208. If IAG actually dropped to my net 195 entry, I would be worried about what's wrong with IAG. With ABX, I know them well enough to not be worried about why they're there. CLF, though, we officially put CLF into our long-term portfolio yesterday. We love that one. All right, that's a very good trade because you're netting into CLF for a 13.60 entry by selling the 2016 $18 puts for $4.40. All right, and moving on down. So we talked about that. Finances, we don't like banks because they're all getting fined. I think you guys will see that from the news. So the banks are all getting fined, and they're also getting regulated, which means they're going to have less opportunity to make a lot of money. So therefore, the net earnings of the banks go down, and therefore the XLF is going to go down. In fact, we have an official trade on that for a short XLF that paid off very well already. So what do we like here? We like Chimera Investments, and Chimera was a trade idea that I had from the beginning of 2013. I had my three top, that time I did on television, but I had my three top trade picks in 2013 in the middle of January, and Chimera went up nicely, up about 30%. We like them still, no reason to change our mind, especially if they pay a fat dividend, but we're buying the stock at $3.03. They pay a dividend of 11.5%. So they pay they actually pay 40 cents. They actually pay 10 cents per quarter. So that's more than 11.5% if they're at $3. But we even do better because what we do is we buy them for $3. We sell the 2015 250 calls for 70 cents. And then we sell the $3 puts for 45 cents. So we're obligating ourselves to buy more at $3 minus the 45 cents we collect at $2.55. So we're obligating ourselves to buy more at $2.55, and we are then we're netting into the stock for $1.88. So in other words, at $1.88, we get called away at $2.50, and that's a 62%. That's a 62-cent gain, about 30%. Plus, we collect another 40 cents. So that's another 20%. So you're talking about a 50% gain on a stock that's $3, and all it has to do for us to win is to hold $3 for the year. It doesn't even have to go up, and we're going to make that money. So I love that. That's a fantastic play, nice cheap stock. Anybody can do it, and buying Chimera with their dividend at $3, also a lovely way to play. Hovnanian, that's the builder, they do not pay a dividend. So there's no reason to own it. PC, I have this thing about saying, it's like, why should I own a stock if they're not going to pay me a dividend when we know how to artificially own the stock with, for a lot less capital outlay? In other words, why should they hold my money if I can do it artificially? And I'll show you how it's really works when we get to Apple. But Hovnanian is a nice one because you can buy the $4 calls. That's what this means. You buy the $4 calls, you sell the $7 calls to somebody else. You're netting in for $1.30 on the $3 spread. But then, because we like Hovnanian well enough to own it for $4, we'll sell the $4 puts for $80, which is a net $3.20 entry there. And now the net of this $1.30 minus 80 is 50 cents. So we're paying 50 cents for a $3 spread. All right, so you have a 500% upside of cash on that trade. And the worst case scenario is you end up owning Hovnanian for $4.50. All right, and currently it's at 5 something. In fact, where was it? It was at 5.43. So dollar off. So you're getting almost a 20% discount. This is why you have to learn options. All right, because I know this sounds crazy, and you probably say, how does that work? Who's going to check? If you guys aren't familiar with options, I strongly suggest you start taking these classes because, holy cow, look at this trade. The worst thing that can happen to you is you own Hovnanian for $1 less, to 20% off the current price. The best thing that happens to you, you make a 500% return on your cash, and all it has to do is go to 7. Now, you don't have to buy the stock for 5 and have it go up to 25 to make 500%. You buy the stock for $4.50, and it goes to 7, and because we're using these options for leverage, you make it. People misuse options, and that's why people get killed using options. And we teach you portion control, and we teach you risk, how to manage your risk, and how to take these trades as Mike said earlier, if you own them. All right, you're taking an ownership perspective on Hovnanian, and we talk about that down here. The 450 entry being your worst case, and I'm advocating in this case 25 of these spreads. 25 of these spreads means you're controlling 2,500 shares, all right, and your net is about 450, so you're talking about roughly $10,000 of Hovnanian stock would be you would own in the worst case. In the best case, you're selling, you're taking the spread and you make 2,500 times 5. You can make $10,500. So you can own $10,500 worth of stock, or you can make $10,500. And don't forget that you're tying up very little margin. This is your actual ownership, and you know if you own stock, unless you have a restricted account like an IRA or something like that. If you have the stock, you're going to have at least only 50% of it's going to be margin. So your at-risk margin is only $5,000 at most on this trade to make $2,500. And we're talking about doing this in 1 year. You know, these are fantastic ways to play them. All right, so I think on the whole, I have to say that Hovnanian trade is just way too good to turn down. So that would be our second best trade. By the way, I'm sorry, I didn't preface this, or maybe I did preface it, but I am not advocating doing any of these trades. You know, I don't mind fishing and trying a little here and there, but we're really looking to do this into next year if the market is holding up. With the indexes breaking down, with the S&P not holding 1,800, with the NASDAQ not holding 4,000, the Dow not holding 16,000, not interested. We'll get way better prices down the road. But the other thing is by setting these up now and having them ready, we'll know when one of them gets much more attractive, and we'll be able to pick the most attractive ones. And most attractive means they lost money and got cheaper, but the most attractive ones are going to be our big targets for next year, and we'll start adding them to our portfolio each week and each month as we move along. But for now, this is essentially our watch list. These are the ones we want to trade next year. So I want to make that very clear. I definitely don't want to see people running out and buying all this stuff. Here's a nice note on the chart of these dividend growth. That's what we're talking about. Chimerido, if you're buying something, I love the stuff that has that kind of return. And NYMT also, if you've never heard of it, they're a mortgage REIT. They're very cheap, $7.27. I like them too, actually. Now, in fact, here's an interesting thing. They're $7.27 mortgage REIT. They pay a 15.9% dividend, right? That's wonderful. But that dividend is only $1.08 for the year. All right? And I say only. That's a lot for 7.7 stock. But why should I even buy the stock? Because what I can do is I can sell the July 750 put for $1.20. And that nets me into the stock at $6.30. So I'm netting in a discount of $1.20 less than it is now. So almost 8% lower than it is now. So I'm basically giving myself a discount on the stock. And if they hold 750 without me having to hedge or do anything else, instead of collecting the dividend, I keep that $1.20 I collected, and I made $1.20 in 7 months instead of waiting a year for $1.08. All right, there's another way. Options beat stocks. All right, and this is why hedge funds make more money. All right, because they can do this all the time. But it's not an exclusive thing to a hedge fund. It's just nobody ever wants to teach you these strategies, because these are the strategies that actually make money, and the brokers and everybody, they keep it to themselves. You know, even your money managers, they want to tell you what they actually do with your money. You know, when you invest in a lot of these bond funds and things like that, that's what they're doing. They're hedging this stuff all over the place with different kinds of options, because they can leverage the money and make the money. It's very simple for them. And if you ever call it these deals where they promise you a certain rate of return if the stock stays over a certain price and so on and so forth, all they're doing is buying an option on your behalf. That's all it is. They promise you a rate of return unless the stock falls below X. That's a put. That's all it is. All right, they're buying puts. You're giving them your money. They're buying puts. They can't possibly lose, and they're going to make a lot of money if it goes your way, because they're collecting that spread. I'm teaching you how to be the guy who collects the spread, and that's what we call being the house. So we're off to this day. That was day number 1. And how are we doing for time? 12:24. Not bad. Not bad at all. This one's supposed to be done within an hour, so I have to keep on time in this one. Usually we have a little extra time. When we do our weekly one, I tend to run over because I'm very gathered. Let me just see if there's any questions aside from the audio. I'm sorry if people are having trouble with the audio. We currently will send out a rebroadcast. I'm not quite sure why. All right. So nobody seems to have any questions about what we're doing so far. We have our Pink Floyd quote of the day, and we are moving on. Now, the same weakness, see this thing where we start up high and we go low? Now watch what happens today. We got the same thing on the SPY right now. There you go. See that? Jammed up. This is no volume on the futures. This is really selling volume. People are selling here. This opening volume is sale, sale, sale. I'm not sure you can see it, but the volume bars are way up here. Then they go down, and here you see some more. But these aren't really buyers. This thing's just flatlining, and it's the same exact pattern as we had yesterday. Opens good, sells off, then kind of creeps back up on very, very low volume, and then big volume at the end. Half the day's volume is done right here in this like little block. That's where half the day's volume comes in, all downhill, which means you're in a fake market essentially. All right. Sky asks, what about water utilities? Well, we didn't really hit your water utility. They don't love water. Not my favorite utility to go after. All right, so where are we? We are back. And this is what we know. This is today's article. Everybody got this, subscribers and everybody got this stuff at 8:30 this morning. Or let's see what time we did. 7:43 is when this thing began. It was probably halfway finished by 7:43, and we'll finish it off in progress. But I like people to have it, if they're going to work early, they want to take a look at it on the bus or whatever, I like people to have it as soon as possible. So while I'm writing it, I'll publish it and let people see it early. And yes to that. Okay. Laura, you asked how you set up the desktop to see all these screens. I will show you that at a later date. I hope you're one of our members. Next week, I'll be happy to do that, but right now it's really kind of off topic. Okay. Same goes for water utilities. I'm really happy to look into those. Let's see. Now, we talked about the Fed meeting, and here, don't forget, we have the Fed meeting next week. This market is going to fly one way or the other, most likely to the top, or actually it'd be funny if it burns everyone in flatline. And everybody who bet anything is going to be upset. We won't be upset. We're in cash. We could care less. In fact, I bet I wrote that here. I don't know. I'm pretty sure I wrote that somewhere this morning. We could care less because we're in cash. Anyhow, so we're looking at where we are now. Here's our line. So, by the way, we have a thing called the 5% rule. And I won't get into explaining it now, but it tells us with great clarity what the markets are doing. And we have, hi, Chrissy, are we giving a special on our membership? Sure. I mean, click on, Mike's going to give you the link afterwards. You'll see. They're fantastic deals. It's Christmas. Why wouldn't we? Dow is, the Dow we were looking 15,820 to hold, and it's not holding, is it? 1 second. Excuse me while I mouse over to my other screen. I have many, many screens besides the one you're looking at, frankly. All right, so I read the up-to-date numbers. The Dow is now 15,903. All right, so it's getting towards this weak territory, and if it fails weak, that's a very bad sign. Right now, it's between the weak and strong bounces we expect. The S&P is at 1779. It failed. I mean, it failed all day, though. It failed the week down. The NASDAQ is 4006, also has turned red. So from this morning, it's gotten worse. The NYSE is 10,006, just right on that line now. And the Russell is 1117, and right there on that line. So what we're going to watch closely, since they're on the lines, is you're going to watch 116 to hold, 1,116 to hold on the Russell, and you're going to watch 10,000 on the NYSE. And if those guys fail, that is a fantastic sign to go short. All right, that's probably not going to fail ahead of the Fed, though. I think those will be big support lines. I'll tell you the funny thing about these lines, though, these 5% lines, we use these same lines all year long. In fact, frankly, we've been using the same lines following the same rules since 2009, and we were able to predict. So in other words, when you see a number, and I'm hitting 10,000 on the NYSE, and we tell you that's the spot, that spot is the spot we predicted 5 years ago. All right, and that's where we are now, and it is exactly the point of contention we expect it to be. It's one of the greatest ways we've ever devised to follow the market technically. And I'm not a technical guy. I don't believe in technicals, but what I do believe in is statistics. And what we do is we run a statistical analysis of the market, and we play based on, it's a long story, but I mean, my father and I used to consult on computer systems, the same systems that now are the early versions of what are now the high-frequency trading systems. We used to design the early versions of them, so we know exactly how the guts of these things work. And that's what rules the market. And frankly, the more the bots that trade in the market, the more we like it. So that's just one of the systems that we use to predict. It's fairly simple. We teach it to our members, and it's a great way to be able to follow the market and see what's going ahead. In fact, Chrissy's saying, how do you forecast so far ahead? Well, that's how. It's really nothing more than knowing how the machines operate and knowing how people trade and then taking the big macro factors into account. I'm very much a macro analyst more than anything else. All right, TA is really for dummies from my perspective. You have to pay attention to it because so many other people use it, but it has nothing to do with what the market's going to do. It really doesn't. It's just it's a way of people interpreting the signs they see. No more so than astrology has to do with how the universe is created. All you're doing is interpreting from what you see and then trying to explain to people what this might mean. But it really has nothing to do with why those stars are up there or why they're in those shapes. And obviously the shapes are very speculative anyway. That's essentially what TA is to me. So a 5% rule is not TA, it's math. It's a very big difference from my perspective. Oh, here it is. I can't be more clear than this. We do this all the time. As I keep saying, we are in cash. We do not care. All right? But you guys pay me to come up with trade ideas. We're very bearish in our short-term portfolio because given the 50-50 outcome of the Fed meeting, there is overhead resistance from our strong downlines. Golly, and they all failed. All right? To the downside, we can make some very serious money, so it's simply fun to play like that. By the way, yesterday in our short-term portfolio, I knew there was a tab I forgot to put up. Shame on me. Okay. We use for our portfolios, we use poweropt.com. All right. And if you use my name, they'll give you a couple of weeks free trial. You can always check it out. It's a monthly fee system. It's really fun for keeping a practice portfolio. And go to the profit loss portfolio. I'm going to show you the trade we did yesterday, which was Facebook. And that was in our short-term portfolio. Oh, it was down 0%. So our long-term trades, this is great, because our long-term trades are holding up. All right, that's all we care about. Our long-term trades are holding up. Our short-term trades are profitable, 0.5%, so we're up about $500 here. But that's good because the market's tanking. That's what we want it to be like. And like I said, we went in with a revenue-neutral strategy because we don't trust the market into the beginning of the year. In January, we'll change and get a little bit more aggressive with direction. But we've collected $18,000 in premium fees, and that time is paying on those people. So they're paying us even though they don't realize it, and even though it's not showing up in that portfolio yet. Yesterday, we added this Facebook January 5250 put because we think tomorrow they're going to release their new advertising system and people are going to go crazy and hate it. That's our theory. It's a guess. It's a binary outcome. It could go either way. But we like this put. The risk reward on taking this put was attractive to us. We went in $1.58 yesterday at the seminar that we did yesterday, and now it's up already 4.4%, but that's not a big deal. So I still like it, especially if you can get it for 160 as it bounces around. I think it's fun, and especially if it goes higher on the Fed, I'm still going to like it because I think tomorrow Facebook's going to have some big trouble, and we'll see. That'll be a fun trade to keep an eye on. Oh, I'm sorry. I went to the wrong place. So I wanted to mention that before it gets away. So if you want to trade now, make that trade, and we'll see. We'll talk about it next week and see if it pays for your seminar. Then you won't be able to complain about the price. All right. Talk about these trades. Here we go. Now we're looking at real estate financial. I mentioned that I almost included, I see. We left it off at real estate financial. I said I almost included Sears in that group because Sears is essentially a real estate play. At this point, Sears is heading for a breakup. What I like about Sears is there's 4,000 locations of Sears. I'm guessing, but I'm going to guess it's about 2,500 actual retail stores, like Sears, like you're used to going to at the mall. There's a couple of thousand of those around the country. Then there's about, about 1,500 almost that. Okay, let's go 2,000 stores, 1,500 catalog locations. If you're in a small town, you know what a Sears catalog store is. They're small Sears outlets, basically. And then there's another 500 specialty stores that like some are actually dedicated to Maytag or whatever. That's the Sears network. Now, everybody imagine everybody can name 3 Sears locations that they know of that are worth more than $1 million. All right? Don't forget, Sears has been around for 100 years. If there's a mall and there's a Sears in it, it's probably been there since they built the mall. Sears probably owns a piece of that mall, in fact, or has a long-term lease and incredibly attractive terms. If you're in a town, they almost certainly own the actual building that the store is in. And you think of like how many Sears locations that you know of that are worth over $1 million. And I'm telling you that the entire market cap of Sears is $4 billion. So these stores are basically, I'm sorry, let me double check that, but it seems like a ridiculously low number. I hate to be wrong. So I'm going to check that here. We're going to put in SHLD. Yeah, 4.6 billion. I mean, that's just insane. So you got 4.6 billion. 4.6. No commas. That's nice. View. Isn't that crazy? Digital. There you go. So 4.6 billion divided by 4,000 locations. So 1.15 million per location. Forget the business, forget everything, forget the brands. They're priced at 1.15 million per location. All right, and I know the Sears in Hackensack, for example, it's a huge building instead of Hackensack, New Jersey, at least a $5 million, maybe $10 million building by itself. They are hugely underpriced for their breakup value. All right, so that's why I like Sears when they're this low. I don't like them when they're higher. I like them when they're this low. And so we really like this trade. I can't pick one from this category, so I have to pick Apple. That was last year's pick of the year, and that hit our goal. We made about 600% on that trade over the course of the year. This trade is almost identical. We'll get into that next up, but I'm talking about Sears at the moment. And so we're talking about buying the Sears. Again, man, don't pay a dividend, so why would I own it? But we're buying the 40.55 bull call spread. The stock is at 44.55, so this is in the money by 4.50. We're buying it for 5.50, the spread, so we're capping our upside. We can't make more than $15 because at 55, at that point, we have to start paying this guy whatever is above 55. But we still make $15, plus our 40 still makes the money, but then we have to give it to him. So it makes a $15 limit upside on our cap. But watch what we're doing. We're paying $5.50, but then we're selling the $30 puts for $6.65. Again, this is where options are better than owning a stock, because here the options give us a net credit of $1.15. So our worst case entry on Sears is $28.85. That's our worst case, is $28.85. I don't even know how. What's that? $16 divided by 44. This is rough. 36%. So 36% off the current price of Sears is our worst case entry on this spread. Our best case is that we have a net credit of $1.15 and we make the full $15. So a 10 times upside, 1,000% upside on this trade. How's that? You don't get that with stocks. All right, but you do get that with options when you learn how to play them properly. And again, we're limiting our downside. We're not having unlimited downside. We are limiting our downside. All right. I'm sorry, I'm looking at the chat. Steve says, when you repeat the Facebook, it's right there. You just go to the website and you can take a look at the whole thing. It's written out. And Apple says, all right, Chrissy's asking the Apple. So we're going to talk about the Apple trade now. We love Apple. We hope, somebody just asked me how low I think Apple can go. It's selling off today. And I said, I hope it goes to 400. And this is another very interesting side effect of learning how to trade the way we do. We love it when our stocks get cheaper. All right? You know, when you guys are watching the market, if you're a stock trader, you're panicking when the stock market goes up. We love it. We wait for this stuff. And even if we own the stock, we don't care because it gives us, we know that when the stock starts plunging, we have ways to do what I'm doing right here, what I'm showing you. We have ways to sell options create a tremendous discount on the stock, and we know how to take advantage of the upside with artificial ownership. Instead of actually owning the stock, we create artificial entities that give us the same upside or a better upside on the stock than you get if you own it. And we don't have to sit there hopelessly watching it die on. It's a wonderful, wonderful way to play. All right, so this year's Apple play, I won't get into last year. If you want to click here, you'll see my pick on TV of Apple and what we did. And obviously, you'll see it's completely in the money. Here we are getting close to the end of the year. It's completely in the money. This next year, we can go with the 2015. Don't get Apple's at 5. Even with this tip, Apple's at 542. As of this morning, it's probably better now. Better as in cheaper. As in Apple got cheaper, this spread gets a lot cheaper too. The 2015 500-650 bull call spread. Buy the 500 call, sell the 650 call. You net 44.30. Here's the thing that makes it a killer. You sell the 2016 $400 put. So I'm obligating myself to buy Apple for $400 in 2016. They're going to pay me $30 to do that. They're paying me $30 to promise to buy Apple for $400, which is $150 lower than it is now. So it's a 25% discount basically to Apple, more than 25%. So basically, I mean, imagine this. It's like, you know, if you're buying a Mercedes, a $50,000 Mercedes, and the guy says to you, I tell you what, you know, like, what's that about? 540. So let's say it's a $54,000 Mercedes, okay? You look at the car, you like the car, you want the car, and the dealer says to you, hey, I tell you what, if you promise to buy this Mercedes for $30,000 in 2014, I'm sorry, if you promise to buy it for $40,000 in 2014 instead of $54,000 now, I will pay you $30. I'm sorry, I pay you $3,000 just to go away and come back, because that's what they're doing. They're paying you $30 to promise to buy Apple for $400 in 2016 for less. So just like logically, you may say to yourself, you know what, I'll keep my other car for a while, and I'll take the $3,000, and I'll promise to buy this car for $40,000 instead of $54,000. I don't mind that deal. In fact, it's almost illogical not to take that deal. What, are you insist that you pay $54,000 now? Do you need it that badly? That's how we teach you to play stocks. You don't need it that badly now. We're going to teach you how to do it better. We're going to teach you how to be more patient, how to take advantage of opportunities, and how to maximize your returns while minimizing your risks. It's a whole different world. It's almost the opposite of what you've learned how to trade, because people are not focused. Options are very counterintuitive. You have to learn how to trade them, but it's not that hard until you say, in fact, what I'm telling you, if that makes sense to you, then you can learn this. If you can learn to be patient and you can learn to get paid to not own the stock, we can teach you this stuff. All right? Now, Chrissy asks, how do you close the trade when going against you? We're generally fundamentalists, so it depends what going against you means. If the numbers going against you, like that AT&T trade we talked about earlier, that one, it's 170% against it, but we're never going to close that because we want to buy AT&T for $30. Our worst case scenario is we get to buy AT&T for $30. So it's only at 34, 35 now. So there's no problem for me. I don't mind it's 35, and I don't care if it goes to 30. In fact, I don't care if it goes to 27 because it's only at 30. I'm not going to worry about that trade. It's going to look horrible in our portfolio. It's going to show an incredibly large negative percentage. But the reality is I'm waiting patiently to buy my stock at $27. Now, if it's a stock where the fundamental information changed and I no longer feel it has that value, then I'm going to get out of the trade. But we're more driven by changes in value than we are by changes in price. Price and value are very, very disconnected, especially in this market. All right. So that takes care of those two. And then our last one, perfect. Oh, this is a hard one. An example of where the fundamental story will change. Let's see. Sure. Hang on a second. I can't. Well, yeah, like for example, for a fundamental story of change, we're short Exxon. Why are we short Exxon? Exxon's a phenomenal company. Nothing wrong with Exxon. They're great. They're diversified. They're world dominating. They buy all the Congress people. You can't do better than what they do from a corporate perspective. But oil is falling, and we think oil is going to fall, although right now it's going back up, but we think oil is going to go down to about $85 a barrel. That's going to hurt Exxon. So if that happens, and we're predicting it happens, so we're a little bit ahead on that trade, but if that happens, then Exxon's fundamental ability to make money has changed. They can't physically they won't be able to make the same money doing the same thing, taking the same amount of oil out of the ground, selling the same oil in the same places. When the oil price less, they make less money. ABX too. ABX was $30 last year. Now it's $17. We love them at 17. We didn't like them at 30, but we love them at 17. Why? Because gold dropped, and it cut into their profit margin. So that's simple fundamental reasons. When do we close out a position? That's a good question. I think a couple of people asked that. All right, my Apple position, let's go back to that just for a second. The Apple position here, how much is it going to make us? We're paying $14. We're going to net $150. It's a 15-month trade, not counting 2016. Okay, we'll close them out that bonus money, but realistically, we're looking on track to make $150 over the course of 12 months. So roughly, we're looking to make $10 a month. So when do I close a trade? On track is making $10 a month. And let's say in the third month, I'm up $50. All right? That's off track. Now, I'm 2 months ahead of the game in 3 months. That's probably a time I might want to take some profit off the table. All right? So it depends on, and it also depends on why we're up. Was there a fundamental difference that Apple's now been repriced higher, like they had blowout numbers? And so now I'm going to eat. So now even I'm like saying, oh, damn, I wish I got the 700 bull call spread or 800 bull call spread. So if it's fundamentally better, I may let it ride. But if it's basically the same, and for some reason, some people got excited about Apple, like China. In fact, like just this week, Apple went popping up because of China Mobile story coming through where they're going to sell phones in China. We knew they were going to sell phones in China. I mean, more phones in China. We knew they were going to sell more phones in China. That was never a question. So to us, it didn't change the fundamental reason. We had a target on Apple. Our target on Apple doesn't change. But the sentiment on Apple changed, and it went up slightly. And in fact, we shorted some Apple shares at 560 because we felt that it was a little bit overvalued. All right, same thing with Facebook, frankly. It went up tremendously, went up 25% in the last month, and we put our foot down at $55 and said, we're going to start shorting it. And so we took a contrary position. Sorry about where they are still. All right, so that's, it's all about the fundamentals. We believe me, we discuss them every day and every week, and you'll read about them here, and you'll hear about them on our seminars. We're really into these fundamentals. We'll teach you why you're buying a stock. It's not one of these things where you randomly go, buy, sell. That's idiotic. Because it's very hard. It's very, one thing, it's stressful. I mean, it's very stressful to be into positions you don't even know why you're in it. It's like randomly betting on horses. Like, you don't know why you picked that horse. I like the number. I like the color. No. But if you understand what you're betting on, like a football team, too. It's like if you understand what you're betting on, then you understand why you win and why you lose. Maybe you know when it's time. Wouldn't it be great in a football game if you could pull your bet off the table? Like you bet the Giants are going to lose, but then they score 2 touchdowns early on. That's the same thing as being off track. The team you bet against scored 2 touchdowns early on. You say, now they're probably going to win. Well, wouldn't it be nice if you should close your bet down and take most of your money off the table when that happens? Yeah, why? Because the facts change. So you change your bet. You can't do that with a football bet, but you can do that with a stock bet. That's the joy of it. All right, so last thing, very quickly, and we'll probably get Mike back on here. Maybe I'll have some time after to talk a little more. So we talked about these trades. We were looking at iRobot, Petrobras. Oh, gosh, I do love Petrobras. I'm sorry, there are 2 trades I have to love here because we figured out how to get a 13,900% upside. I know you guys want to make 13,900%. As is against cash, there is margin, and we don't really have time to get into that, but obviously your margin in the situations you would end up owning it. We talked about the allocations. And again, don't forget, we don't want to make these trades right now, but these are the kind of trades we want to look at. I'm sorry, Laura's asking, if you're the only one I've ever heard of with such widespread, why is that? Oh, that's a tough question, Chrissy. Please ask that next week. It's a good one. We can talk about it in detail. And Laura says, do we teach beginners? Yes, every week we answer easier questions. And Mike is going to talk about pricing also, so you'll be able to find that out. We also work with Market Tamer. Market Tamer does all early trading and stuff. They're wonderful for that stuff. But anyway, so Ford, very quickly, 2016, 1320 bull call spread, 265. Oh, and by the way, when you say, why do we have these kind of spreads? This is our target. All right, Ford is currently at 1670. I don't think I'm going crazy by having a 2-year target that they get to 20. All right, and I also don't think I'm crazy in 2016 to promise to pay $15 to own them. So in other words, 2 years from now, I'm willing to own Ford, which is now at 17. I'm willing to own it 15 2 years from now. How much am I going to pay for that privilege? I'm going to pay a nickel. I'm going to pay a nickel, and all I'm going to do is promise to buy Ford if it gets to $15. But my upside, if it doesn't get to $15 and instead goes up and up and up, then if it gets to 20, I'm going to make I'll make $6.95 on this 1320 spread. All right, that's $6.95 per nickel, 13,900% profit. All right, you don't have to bet a lot of money, and that's your upside. Petrobras, same thing. In fact, it's exactly the same spread, and I'm even selling lower puts here because people have really turned on these guys. Petrobras is an oil company in Brazil, and it's too good to turn down. It's just too cheap right now. And even though we are bearish on oil, we're not that bearish. So we think that over time, in fact, this one we're playing a little closer. So in 2015, we think by the end of the year, Petrobras, which is now trading at $13.50, we think that they can go all the way to 20. But frankly, we don't care. As long as they're over 13, we make money. So if they're at $13, $14, we make $1. If they're at $15, we make $2. Anything over 13, we make money. All right, and they're currently at 13.53. So this is built in 10 times return from our nickel just to start this trade. And again, better. Options are better than stocks. And I just mentioned iRobot, our stock of the century. We love iRobot. Okay, so that stock I predict is going to be a $100 stock, and you can sell the $30 puts for $250. You net in at $27.50 with iRobot currently about $35. So that's a great way to begin to get involved at a significant discount.